Hello, everyone. Thank you again for coming. If you follow my content, you know I love to say intangible asset a lot. Now, mind you, I spend a lot of time on Google, and if there's anything that I don't quite have an understanding of and I'd like to get a little bit more insight into, I go to Google first before I get to the other forms of research and that type of thing. So, according to Investopedia.com, what is an intangible asset? Intangible asset. Intangible asset. An intangible asset is not physical in nature, y'all. Goodwill, brand recognition, those are all intellectual properties. They include patents, trademarks, and copyrights. All of these items fall under intangible assets. This also includes your social media content, because if you think about it, it's not something that's physical in nature. But without it, we the consumers wouldn't have anything to consume when we're online. So somebody's making money off of it. Now, intangible assets exist in opposition to tangible assets, which include things like land, vehicles, equipment, and inventory. Now, financial assets like stocks and bonds, they're considered tangible assets because their value is intrinsic and is based upon being derived from actual contractual claims. So somebody's written, something down and they have a hard copy trail to actually represent the asset. So the key takeaway from that intro is, number one, intangible assets are not physical in nature. Secondly, you or a business can create or acquire intangible assets. Next takeaway, an intangible asset can be considered indefinite, i.e., like a brand name or some intellectual property, or it can be defined as definite, like a legal agreement or a contract. Now, intangible assets created by a company do not appear on the balance sheet and have no recorded book value. So, we just brought up a couple more terms: indefinite and definite, as far as tangible and intangible assets are concerned. Now, indefinite, intangible assets, they're the kind that stay with the company for as long as it continues in operation. An example of a definite intangible asset would be like a legal agreement to operate under another company's patent with no plans of extending the agreement. Therefore, the agreement has a limited life and is classified as a definite asset. While an intangible asset doesn't have the obvious physical value of, say, a factory or equipment, it can prove valuable for a firm and be critical to its long-term success or failure. For instance, a business such as No Limit wouldn't be nearly as successful if not from the money made through brand recognition. Even though brand recognition is not a physical asset that can be seen or touched, but it can have a meaningful impact on generating sales. Next topic, valuing intangible assets. Now, businesses can create or acquire intangible assets. For example, a business may create a mailing list of clients or establish a patent. Now, if a business creates an intangible asset, it can write off the expenses from this process, such as filing the patent application, hiring a lawyer, and also paying other related costs. In addition, all the expenses along the way of creating the intangible assets created by a company do not appear on the balance sheet and have no recorded book value. Now, because of this, when a company is purchased, often the purchase price is above the book value of assets on the balance sheet. Because of this, the purchasing company records the premium paid as an intangible asset on its balance sheet. Next, we'll cover examples of intangible assets. Now, as I stated, creative content is an intangible asset because without content, we don't have anything to research or to keep our attention. Intangible assets only appear on the balance sheet if they have been acquired. Say, for instance, if company JBP purchases a patent from company XYZ for an agreed upon amount of, say, $1 billion, then company JBP would record a transaction for $1 billion in intangible assets that would appear under long-term assets. The $1 billion asset would then be written off over a period of years, a period of time, via amortization. And amortization is an accounting technique used to periodically lower the book value of generally loans, but also of intangible assets over a set period of time. Now, when it's referencing a loan, amortization focuses on spreading out loan payments over a period of time. Now, when it's applied to an intangible asset, amortization or amortization, however you want to pronounce it, is more similar to depreciation. And that covers the basics of intangible assets. They're very popular now. You should look into them. And I thank you for stopping by. Until next time, have a great one.